Welcome to Inside the Rope, the podcast where we speak to the leading minds in wealth management. I'm your host, David Clark, and I'm here with Tom Oriel. Tom, in this episode, we're talking to GQG, to David Jenkins. What are you excited about? What are you looking forward to?
Yeah, Clark, I think it's going to be a really good episode. We're sort of in this big AI hype train at the moment, and most of the market is trending in that direction. On the other side, there are a few contrarians out there, and GQG seems to be the prominent one. In fact, coming into this meeting about half an hour before we walked in here, they just sent out another email in their .com on steroids series that they're putting together. This is a manager that had a few years ago one of the largest exposures to NVIDIA back in a time when half the market couldn't even tell you how to spell the word NVIDIA. And now it's one of the most, tightly held stocks in the market. So just learning about their thoughts on, why are they cautious on AI and they're spending in AI? What are they looking at if they're not looking at AI? And then also subsequent to that, just things about infrastructure. Data centers are now being called infrastructure. How that compares to a traditional toll road. What are the sort of counterparts on the other side of a data center trade? How secure is that? And his thoughts about that classification should be really interesting.
Yeah, I think Ravid Jain, who set up the fund and rolling out GQG, they're just a huge organisation with a very impressive track record. One always gets a little bit concerned when you see a lot of hype and a lot of run-up, and we've certainly seen that in this area. So I think it's always good to get a view from intelligent people.
Absolutely. All right, well, let's kick it away.
David Jenkins, welcome to Inside the Rope.
David, pleasure to be here.
David, perhaps you could kick off for our listeners and give them a bit of an understanding of who you are and your background and your role.
Yeah, sure. So, I've been working in the wealth management industry in Australia for 20 years. I've been with GQG for the last 4. Last 2 years, I've been in this client portfolio manager role, which we have uniquely kind of leveraged at GQG. We're a very small shop, I guess, in terms of total staff. We've only got 240 globally. And we've got a reasonably tight investment team as well. I have 14 sort of analysts working on there at all times, plus a development program. So because of our scale, in Australian dollar terms, I think we now manage, circa $250 billion. We don't have the PM's time freely available to speak to all of our bigger clients. So we have this subset of the investment team, client portfolio managers, that goes out and speaks on the behalf of the PMs and the analysts to our bigger clients. So as a part of that, we're involved in the majority of conversations with the PMs week to week, get access to all the analyst updates in our internal system. So it's a great leverage position to speak on behalf of the investment team without being on the hook for stock decisions.
Okay. So let's talk a little bit and break down for our listeners, who is GQG? It's been quite a growth story, but perhaps you could give us a little bit of a background as to, how the firm came about and its history and sort of how it approaches things.
Yeah. So, our CIO is the big part of the initial story, a guy named Rajiv Jain. He worked for a Swiss private bank called Vontobel for a long time, and he started out there managing emerging markets funds as a PM. And he's one of, I think, very few, if not the only one I can think of off the top of my head, that's raised more than $50 billion US twice in terms of capital over time. When he took over at Vontobel, he had quite a small book. And built that up with a big institutional following in the US. And after a period of time, he was ready to start his own shop. So he was seeding some funds in his last couple of years at Vontobel. And then a guy named Tim Carver, who's our CEO now, contacted him and had been contacting him for a long time. He's a very successful PM who wasn't running their own shop. It was a target for GP stakes type investment businesses where Tim Carver was. And when Rajiv was ready to step up and start his own business, he called Tim. And what I found interesting actually when he made that call is Tim had put money towards a number of investment managers over time, but it was when Rajiv called that he decided to step out and start the business with him as well, which I think speaks to the quality of Rajiv as an investor. So they started back in 2016. So this is our 10-year anniversary at GQG. And as I said before, we've now raised in Australian dollar terms, close to $250 billion. So it's been a very successful first 10 years as a business. To start off, we raised a lot of institutional capital, and over the last 5 years or so, we've really broadened that client base. So we have a mix of wholesale, sub-advisory, and other institutional businesses.
Yeah, I think one of the interesting side points is, this is one of these classic manager within a larger organization, taking their skills as, what's the basketballer's name? He said, I'm taking my skills to South Beach, Florida, although he went to Fort Lauderdale here, out on their own. I think 40% of that Von Tobel client base actually followed him then. Interesting, the business is listed in the ASX. Now, this is a global business headquartered and centered out of Fort Lauderdale, am I right?
Yeah, that's right.
To be listed on the ASX, explain how that happened and why that happened.
Well, there's a number of reasons for that. I mean, there's a few that Tim talks about as our CEO, and one of them was when Rajiv called him. He was walking, he was in Manly at the time because he was at Pacific Current Group as a CEO, and it was an ASX-listed business, so he had some experience running an ASX-listed business. So he always speaks about having an affinity with the Australian market. The other thing too is just from a visibility to analyst side of things. Australia is the market where GQG gets the most noise. The team here experiences it more than any other team. And to have it more so in the Australian press as a listed business is less of a distraction for the team of the US. But what it also does at the same time is allows Rajiv and the other senior members of the business to give equity stakes to analysts and build their connection with GQG without the huge listed noise that you see. The other thing that I think is interesting is it's a lot easier to manage updates in Australia versus the US. So Australia, you do 2 states and 2 updates a year. Whereas in the US, you're updating quarterly, you're doing a roadshow across 16 plus states. So just from an efficiency point of view, it's a lot easier to list here.
In managing the investors. And most of the investors in the headstock are what type of people? Is that mums and dads, or is that strategic equity?
Yeah, it's been a mix over time. I mean, the biggest holders of GQG stock are our CEO and CIO.
Yep. So I think Rajiv holds most of his personal wealth is in GQG stock.
Yeah, that's right. And what was interesting about the listing itself and the timing of the listing, I guess, is probably important as well. But post the listing and post listing on the ASX, both Tim and Rajiv put more than 95% of the after-tax profits back into strategies and locked them up for a 7-year period. So very much that co-investment piece as well as that co-ownership piece along the way.
So strong alignment of interest.
Great strong alignment. Yeah, very much eating our own cooking, and that's across the board amongst all staff. But to your point, there is a broad spectrum of investors. I think one of the challenges, not to speak too directly on the stock price itself, has been, until recently, we haven't been in the ASX 200. Those rules have changed, so that's deepened the share base a little bit too, which you'd think historically would lower the volatility, but we'll see how that tracks over time.
And most of the investors in the funds look like what I think you talked a little bit about. Mainly, it's been institutional money, and that's broadened out a little bit. Is that mainly Australian super funds and Australian institutions?
Yeah, so if I talked about the Australian holdings individually, globally it's a great split. It's maybe a third, I think, from memory in terms of institutional, sub-advisory and wholesale. But in Australia, it's about 50-50 in terms of the funds under management. I mean, one of the first clients we had was Australian Super. They were investing with Rajiv Von Tobel and they, put an emerging markets investment in very early days. But in Australia, the funds split about 50-50.
And geographically, the investor base in the funds is what looks like what?
Yeah, I think, you mean globally or?
Yeah, globally.
Globally, I mean, our biggest amount of investments in the US.
Okay.
It's a 10 times the market of Australia. Institutionally, investors don't have to come to the benchmark as closely as they do within the Australian superannuation system. That's a completely different topic, though, I think. And a lot of the growth we had in our earlier years were, US institutional investors that followed Rajiv from Von Tobel, to your earlier point about how much money came across that had seen him before.
Okay. So just for the listeners, the metrics today are what? How many employees are there? I think it's something like 239. You call them associates.
Yeah.
Is that right? And what is it? 163 billion US under advice?
Yeah, the way I like to describe it, and I always cheekily kind of lead into Australian dollar terms, is we've broadly got $1 billion under management per staff member.
Okay.
So, I mean, what we do is we have a series of, third-party distribution arrangements that we use in different countries, and anything that we don't think we can do the best internally, we'll then kind of outsource to or partner with other good businesses kind of globally. And that allows us to keep staffing numbers down. And if you look at the last few ASX reports that come out, you'll see those staff numbers have been pretty steady now, kind of through 2025. And we've managed to control that quite well as we've cemented sort of our operations in different countries.
Okay. And so let's pivot a little bit around as to who and what GQG is and how the firm thinks about investment and its style, and maybe lead that into a little bit of its track record, if you can, please.
Yeah, sure. I mean, what we do at GQG is very much founded on this concept of forward-looking quality. And at its sort of outset, it's a very simple way of describing things. We want to underwrite businesses that show quality attributes in a 3 to 5 year period. It's founded on this concept, and even our name, GQG, is Global Quality Growth, right?
Mm-hmm.
So
there's too many acronyms like this in the Australian market.
Yeah.
I can't keep up with who's who.
Well, yeah,
I think you guys started it.
I mean, yeah, I think too, if you look at some other managers out there, you've got to question their research process if they didn't see GQG as an existing acronym, but that's a different conversation again as well. So, I mean, when it comes to style, we're built on this concept of quality growth, but it's our view of what quality growth is.
Mm-hmm.
And what's important for us is kind of the direction to travel with quality factors and growth factors and underwriting them on a forward view. So what that means is we're not as kind of pigeonholed into traditional style boxes or style biases, because what might have been quality yesterday is no longer quality today in our view. And the classic example right now is a lot of these big tech companies, and I won't digress there straight away, where we see declining quality attributes and declining growth. So when we see something getting worse, we move away from it. And if we see something that's either, sustainable and giving us a good return or accelerating, improving, that's when we go to it. So we kind of have this yin and yang of rotating the portfolio based on, very simply, stuff getting better or stuff getting worse. And that means we're more kind of a style agnostic manager. So we'll go to areas where we think the best probability of compounding is. Mm-hmm. And that's driven on the rate of change or the changing factors of quality and growth amongst our investment universe.
And I think your style's been described, or I've seen it written online, and some of my research flagged out that you want to own companies that are going to be substantially better than they are in 5 years' time. Does that play into that view of the sort of style that people should expect or think about when they think about GQG?
Yeah, I mean, it's always a subject of, the opportunity set of what's in front of us amongst the stocks we have under coverage. So, yeah.
That opportunity set's very broad, right? That's global and almost anywhere, right?
Yeah, so the team for context manages an emerging market strategy, a US-only strategy, a global strategy, and an international strategy. And the international strategy is global ex-US.
What's the difference between an international and a global strategy?
It's a natural question. And so global is with US and international is global ex-US.
Okay, so it's from a US perspective.
Yeah, I mean, we have most of our client base, or our largest actual strategy is our international fund, which is ex-US.
Okay.
So we do have that broad coverage across every market. And we also think about compounding sort of in 3 buckets, where you've got, say, your pure growth, your high growth names, which are most of the earnings, or all the earnings, are coming from EPS growth.
Yep.
Then your core names, that's got a tiny bit of dividend, and then maybe you go to value or deep value, and it's at least kind of 50-50 in terms of things. And what we think about is what's the best way to compound returns over time. And that's to make sure that if the market does pull back, that you pull back less and you're able to compound from that higher base. So with our view of forward-looking quality, if we see deterioration, we'll sell from things. And that process over time has de-risked the portfolio from having big drawdowns.
Yep.
Because generally that deterioration isn't at the time of price coming off, but it's ahead of it. So you move a little bit early, and then your funds don't go down as much.
Yeah.
And
Wealth management 101. Don't lose money. Don't lose money. People and data and statistics, can often get in the way of that. However, you talked about, rightly so, I think, alignment of interest, and I think it's just so important for people to have managers that are aligned. One of the things that hits my mind when you have, the key decision makers, the people making the analyst calls, making the buy sells, thinking about what equals the outcome, making sure that their idea of success is the investor's idea of success. And that fact that you've got analysts who are US-centric, US-based, thinking about, well, our international fund, which is where a lot of the money is managed, is all ex-US. And I would dare say, do they manage money in US dollar terms? Is that an issue, and how do Australian investors face that? Because most Australian investors will have future liabilities in Australian dollar that they're thinking about in Australian dollars, and when they think about international investment or global investment, they think about that one and the same. Where US, culturally is a little different in that, the US is the US of the US, and by the way, there's some other stuff that happens outside of that. Where I think most Australians, where we sit historically and geographically, are very open to the fact that we're only 2% of capital markets, and a lot of really good ideas, good companies, and good growth stories sit outside of our borders. Is that alignment of interest? How does the firm manage that with an Australian investor?
Yeah, there's a few things to unpack there.
Yeah.
I think what I'd start with is, if you look across our strategies, there's not necessarily, to your point, there's not, a US investment bias in how we've allocated capital over time. There's not a China bias or an India.
But is it a US thinking of success bias? I.e., I've had managers in the past where I've gotten to a point I've gone, oh wow, their definition of success here is a US dollar definition of success. Everything that they report back to me is in USD, and their whole thinking about a position is in US dollars. And my client is thinking in Australian dollar terms. So either we have to hedge it out, which you can do, but it comes with a cost. It's just one of these little things I'm picking on as an alignment of interest point.
So, if we take currency, the way we think about currency when we're managing a portfolio, so let's take our EM portfolio or international or even global. If we're investing in Brazil or we're investing in India, we're not necessarily making a currency call in US dollar terms or Australian dollar terms.
Yep.
We're looking at it. We might rate base it back to USD, but that's just so we have a comparison point. So we can think about what's the most effective place to be compounding capital. We'll look at things like CPI and we'll discount that against future earnings. There's a bit of a proxy to what that future earnings is actually going to be valued at. So it's not necessarily a US-centric view. It's just that we're not necessarily taking short-term currency impacts as a strong input into where we're considering investment. What's more important to us when we're picking stocks is two things. It's how does that earnings growth look? What is its sustainability? What is the dividend like? What's the sustainability of that? What's our fundamental return?
Mm-hmm.
And then at the end, we'll look at the valuation. We're not going, well, the Indian currency might come off this year, so let's not invest in India.
Yep.
So in terms of overall interest, the way that we're managing overall interest is on a fundamental bottom-up earnings growth, total return view, not a US-based currency or Australian-based currency point of view. But, if investors do have a strong bias versus USD, where a lot of the businesses, will be domiciled, even if they're not, we might be using ADRs in the US. Then that hedge version is available, and you can take that position, particularly in our global fund. But we're not thinking about it when we're constructing portfolios, and it's not necessarily a US-centric view. It's just a company fundamental kind of view that we're focusing on.
Okay, and if we think about how things have tracked for GQG since Raj rolled out of Von Tobel, how has performance been? Let's talk about maybe the flagship fund, just to give listeners an idea of, if the dog's eating the dog food.
Yeah, well, I mean, there's a few metrics, and for context, we've just had, one of our poorest relative years across the majority of our strategies. And a large part of that is timing, moving from quite more aggressive posture to a defensive posture, and then participating in the market rally from the year onwards, probably from April onwards. But even despite that, if I looked at the Australian version of the global fund and I'm measuring alpha on a rolling 5-year view, and a rolling month by month, our strike rate of outperformance from an alpha sense is over 90%. And that's after, obviously quite a week.
It's like 50 clients in my head bipping me and you on their head for talking about alpha, because they can't buy, any of their liabilities in future returns. Am I right to think that the global funds had a CAGR or compound annual growth rate of about 10% per annum?
Yeah, that's right.
Okay, so look, double-digit return. I go back to the Berkshire Hathaway. I think someone chipped Warren one year when they were up 15%, and he said that underperformed the market, which was up 20%. And he said, well, if failure is 15% a year, I'll take failure. The definition, double-digit returns. I don't think any of my clients would complain with that. So returns have been okay, but have been reasonable or good. But I think the thing that we're here to talk about and face about is a lot of the growth in the past has come from a lot of technology companies, and it's really interesting. Well, high growth companies, and what defines a technology company through history. We've got railways, cars, steam trains. These huge changes to industry that have taken commerce and economics on leaps forwards. And we are arguably, a lot of people in the market talking about artificial intelligence, and you're seeing, the routing out potentially of white collar workers. We're starting to see it in our industry, and ours just from, really efficient meeting takers to then automating product, document production and these type of things. And the questions, unanswered to a degree of, what does that mean for our workforce? Does it just mean we're getting a lot more work done with the same amount of people, more productivity, margin compression, etc.? GQG has been on the front foot here. There's a series of white papers, which I'll ask you to talk about. But that sort of started with .com on steroids in September 2025.
Yep.
And if I've got it right, my take on that is, that white paper was essentially saying, I was managing clients back in the .com first time round, and I can remember sitting there and having valuations that, oh no, you don't worry about a price earnings multiple. All we need to do is value how many users they've got, because they're a brand new internet service provider, or they're an Oz email.
Yeah.
I can even quote you some of the names here. And of course, that all rolled over terribly, and there's a massive drawdown in the market. I think there's a second white paper you followed up with, AI Still Hallucinating, in the November 25, and then Earnings Growth Mirage in December 2025, talking about this circularity of capital expenditure. Perhaps you can, in your own words, give our listeners a bit of a summary of the white paper thesis and main points GQG is making in those papers, please.
Yeah, I mean, before I touch on that, I'll just add one more thing I think it's important to, and I think it does speak to our position overall, and it comes back to this performance conversation we were having. I recently had a look at rolling 1 year bands of performance over time in our global fund, and then bucketed it, say, to 20 to 30% year, 10 to 20% year, 0 to 10, 0 to 5, and I mean that by index returns. And if you track the performance of our strategies, the higher you go up in terms of index performance, that's when the excess return starts missing by a little bit. Mm-hmm. And you go to that 20 to 30% bucket. And I think since the history of the global fund, we're off about 1.5%, I think, in terms of excess underperformance. We outperform at times, but that's the average. And as you go down each rung and you go all the way down to say -20 or even -30, that's when you see huge outperformance, and you see it come through at say negative up to about 10, upward of 20, depending on your currency or market. But our Australian version.
Okay, so am I right in thinking what you're articulating there is typically you've got a track record and a history of position where markets really fire and run away. You underperform that, but you don't participate in the downside nearly as much.
Yeah, and the reason for that is we tend to identify deterioration and move away from it.
Okay.
And where that's important in context for what these .com on steroid papers are saying is our view is that with any infrastructure build out, and you went through them, we tend to overbuild, we tend to get overexcited, and we tend to overvalue. So what the papers are pointing out is a series of those metrics. So they'll look at the valuations and they'll look at, your price to sales metrics and price to revenue, whatever you want to look at, all those things cut up. And each one of them shows a high concentration, higher multiples at an index level than we saw in the .com period of time. What we've also seen is quite a big deterioration in the revenue models of the businesses that are funding it. On top of that, we're also seeing elements of previous crashes come into things as well. You have inflation, which is potentially not knocked on the head. I mean, it's not all the time that you have China, Japan, and the US all expanding monetary policy. Mm-hmm. I think this concept of inflation being dead is not completely off the table in terms of things that might happen. And then you've got this looser credit environment, again, which, they tried to clean up post the GFC. But all that's happened really is you've taken shadow banking to now be kind of private credit. And not to say all the private credit is bad. I'm not saying it is. There's definitely some great investments and great funds out there. But there are some looser credit aspects that the banks are doing, which is also funding a lot of things that are happening in terms of this CapEx cycle. So what we're talking about as we walk through all these papers is the likelihood of the compute being required being at a stretch, the likelihood of the revenues coming through across the board being a stretch, and the amount of potential triggers for quite an aggressive pullback, again, being even more than just the .com period, because you've got elements of all these other crashes that are in the market right now as well. Mm-hmm. I'll stop there, and I'm sure you've got some other, yeah.
Let's pull that apart a little bit,
yeah.
In that, and I want to test this. And firstly, I congratulate GQG on publishing the paper. To be contrarian is difficult, and to be fundamental based and stick to your knitting is hard, as I think the firm would be probably experiencing now. People say they're absolute return investors when markets have been very poor and they're coming out of GFCs and big, downturns. We'll have clients who'll say, I'm focused on is absolute returns. And then when markets are booming, they'll just come and knock on your door and say, well, my mate down the road, he's in an ETF or, with the local stockbroker, and the market's just gone up. So you get hammered on both sides and people have short memories. But just for the listeners, the Magnificent Seven of Apple, Microsoft, Alphabet, Amazon, Meta, and Tesla. They're large, substantial companies that have real cash flows. If you look at Microsoft, particularly, that is a mature business that has good, strong revenues in many different ways and good cash flow, which is quite different to what we saw in the tech bubble, where you had companies that were driving up values in a way where there was really no earnings and no cash flow. Nvidia, Alphabet, where are the material differences today of what you're seeing, or the similarities that these white papers are calling out?
We kind of move those buckets. So in the case of your .com era, it's not the pet.coms that are driving investment.
Yeah.
It's telcos. So if you go back to the telcos, you look at the amount of money they were spending. They got EBITDA, I think it was circa 70+%. I have to check their percentages. But you look at what's happening now from the hyperscalers, who are the ones that are largely funding this, plus the private credit side. But let's leave that separately.
Mm-hmm.
They've already exceeded that. They're well past the amount of capex to EBITDA.
So the typical hyperscalers are, just for the benefit of our client?
All the companies you listed before.
Yep.
So,
okay.
And if we go through those names and let's assess this free cash flow situation, and that's one of the big narratives that's been a market. These businesses are cash generating machines. They can fund this stuff forever. There's a couple of aspects to that. One is if you're a hardware provider or a semiconductor provider or whatever that portion or bucket of the market is, you need CapEx expenditure to not just sustain but continue to grow.
Mm-hmm.
Because you're not a SaaS business. You're selling chips this year, you're selling chips next year, and that's got to keep going, right? That's how that story keeps going. So if you look at the free cash flow picture, that is not an endless drain that they can tap. If you look at the 2026 estimates across those businesses and you tuck back in share-based compensation or buyback requirements, they're all negative in terms of cash flow this year. They're already out of money. That's happening this year. So there's not this giant amount of cash that they can keep leveraging to keep building this out after this year. And that was always going to be the case the way they were going. And why I mention share-based compensation is it's a large part of, say, software businesses, or the Magnificent Seven businesses, decent proportion. So, if you're expecting to buy 25 or 50 billion back in share buybacks, because you have to, because you're diluting the share base otherwise with share-based compensation, that is a real expense that cuts into free cash flow, which means you can't just keep ramping up CapEx expenditure. So we actually think the market started to recognize that probably since November last year. It feels like that's turning a bit, where investors are really starting to question that return on investment. And the ability for these businesses to keep ramping that up, the runway kind of feels over. And you're seeing that with some of these businesses they're moving stuff off balance sheet. They're borrowing money. They're changing their accounting standards to increase the kind of margins that are coming across. So we would have a strong view that free cash flow machine, it's kind of done. So they've come to a point now where you can't see them continue to materially increase the spending. And when that stops, so does the hardware story.
Mm-hmm. This circularity of it, just articulate the circularity of this CapEx narrative that's been in markets and of concern and is raised in the white papers for GQG.
Yeah, there's probably another layer to it as well. So if you think about cloud computing in general as an industry, it kind of stagnated, back before ChatGPT became, a thing.
Mm-hmm.
And you saw, let's go back 5-6 years, maybe you saw cloud growth was at 40+%. It has slowed down to, your low 20%. And the only thing that's increased it has been this training aspect of large language models and the amount of compute that's required. So if you unpack how all those chains are kind of connected, all of his large language model businesses are all burning cash. None of them are making money. There's no realistic pathway at the moment where they will start making money.
Sure.
So to keep this train going, so the growth in cloud keeps going, there has to be these funding deals to keep putting capital in and give investors confidence to keep adding money to these businesses or the data centers themselves. And that's when you see last quarter of last year, I think NVIDIA invested in 47 projects and they put their name on the bill. Investors get confidence that they're there. This must be realistic. And more credit or capital is raised. And then if you go to, say, the cloud computing guys, they then book these revenue expectations off the back of these startups going, hey, I'm going to come and use this much compute next year or the year after that.
Mm-hmm.
And you see it unravel with something like an Oracle. and it had this huge spike because OpenAI was like, hey, we're going to spend all this money. But they were going to spend money to provide compute services that they don't even have. So they all book these elements of revenue coming through from providers that can't afford it for services they can't even necessarily provide. Mm-hmm. And you have this giant kind of circular revenue expectation that if any of these legs fall over, has a huge cascading effect across the entire market.
And while you're talking about that, I'm turning my mind back to the GFC. And in my mind, I articulate it simply to clients, that was triggered basically by debt and lending securitized in the US, where you had no income, no job. You could get a loan 100% leveraged against your property. And you basically had no recourse on that loan, i.e. if you borrowed $1 million to buy a house for $1 million in Phoenix, Arizona in the Sun Belt, and, in a couple of months' time, it became worth $300,000 or $400,000 less. At $600,000 or $700,000, you could simply mail back the keys. But those securities were wrapped up and put through a balance sheet and sold off by investment banks as A-grade debt, when what actually sat behind them was very, very weak. When you're talking about this, has the firm discussed, or has there been any narrative around this, at the other end of the spectrum to sort of high growth AI companies? We talk to managers around infrastructure and infrastructure management, and most people think about infrastructure as really strong recurring revenue. You wake up each morning and that people are going to cross the harbour bridge and use the tunnel and the shipping ports. And over time, you're seeing more assets creep into that, because when my 14-year-old daughter travels, we've got to have Wi-Fi. So internet and internet services is a necessity in some realms or definitions. So data centers become infrastructure, and now hyperscaler data, it becomes infrastructure as well. Some of these build outs of these chips are now sitting in infrastructure funds, which are sitting inside people's portfolio at the very defensive side of things. But I get a hint of what you're talking about here is GQG would possibly have a view that, well, actually some of these assets are quite risky, and they're probably not anywhere near as dependable as the M1 motorway to those cash flows coming through. Has there ever been discussion of that within GQG?
Yeah, absolutely. And that's kind of where it breaks down. So if you think about how these assets are secured, the length and life of these assets, that's what's very different about this infrastructure build out. So if you go back to the fiber that was built in 2000, still being used today, mm-hmm. Has a long useful life, overbuilt with railroads and canals, whatever you want to compare it to, that's a long life. Whereas these GPUs that are used inside these data centers, they might burn out in 18 months to 3 years. And you're seeing debt secured to these GPUs on 10, 20, 30-year terms mm-hmm. for assets that have to be constantly renewed. So one is that the useful life of these assets is very low. The other is that this infrastructure build out is for a commodity, and that commodity is compute, or you could call it tokens, and charging for tokens. Tokens have declined in terms of the cost for tokens by 90% year on year for 2 years. So, if you're running a pipeline or a highway and you're charging people to come through, you got to offset a 90% decline in the cost or value of that every year in order to make it work. The other piece too is you're also assuming that the need for compute is going to keep kind of ramping up. And that's why, everyone's building out, and there's a whole bunch of other layers to this too. But let's just touch on that and the usefulness of this kind of coming up. And what I was talking about before is where the increase in clouds come from is largely training. But it's not going to be training forever, and training is going to cost less over time. What the world's going to move to is inference. And inference just being, I've got a query, I put it into it might be doing some software work, might be doing, a chat query, that gets sent off to a data center and gives me my answer back. The world's already kind of transitioned, if you speak to some people, to being more inference-based in terms of where the growth's coming from. And inference costs a lot less in terms of compute as well. So if you think about the build out, and you we've got an interesting data scientist kind of we work with or talk to, a guy named Paul Kaczynski, and he would say that if you took all the world's inference costs, and you can't really do this for latency, but let's just say you took all the world's inference costs right now, you could run it out of 2 data centers in the US today. So you've already massively overbuilt. So it's a couple of things. Is one, these assets that are being built, they're not necessarily going to be useful because the assets inside them will break and die. But two, the longer term view is that you're not actually going to need this much compute because the nature of compute requirements are going down or changing. So you're overbuilding things that aren't going to last very long, and you're not going to be able to replace them or need to replace them because the compute's not going to be required. I'll stop there. I'm sure you've got some other things you want to poke out there.
Well, look, I think we could probably move to a bit of a conclusion on this. And,
yeah.
So if GQG is not deploying into these hottest parts of the market, what's GQG deploying into? What type of companies are they looking at and saying, we can see this as seriously being a much better company in 5 years' time than it is now?
Yeah. So the way we've built our portfolios, and this is across EM and global, because if you look at the EM index right now, it's heavily exposed to these aspects. You just have to look at Korea and Taiwan and, to a lesser degree, maybe China as well in terms of the amount of AI exposure. What we're looking for is businesses that their long-term earnings journey is separated from what's going to happen on this, supply-demand side of compute and build-out. And also areas that are not being already used as like kind of natural hedges. Because and the reason I say that is if you look at a natural hedge of this sort of stuff, or what's a popular hedge, if you're in a fund where it's got say software exposure and this hedge there, and the software goes down 30%, they're not going to let this sit there. They're going to have to sell it down in line. So that puts cost pressure on some of those natural hedges, and it might work to start with, but then it kind of unwinds at the same time. So where we're going to is areas that have been less popular, where the earnings are still coming through. We're still seeing growth. And we're seeing that in kind of P&C insurance in the US.
P&C standing for?
So your car insurance is the easiest way.
Okay,
so personal care insurance.
Personal consumer.
Yeah, that's right. Yeah. We're seeing businesses there that have had great growth on a 10-year basis, comparable to the Make 7. But you've seen big valuation compression come down. So you're able to see two things. One is, it's an earnings stream which is not impacted by a lot of these other forces. But two, it's a valuation that potentially has the ability to pop a bit as a result of capital coming out of these other parts of the market. If you think about something like an NVIDIA, say it's bigger than 5 sectors in the US in the index level. Let's say it pulls back a bit. All that money is not coming out of the markets. Maybe some of it does, but it's got to go somewhere else. And what tends to happen is it goes to these areas that have been under-recognized, but are still churning out kind of earnings profiles. We also see it in certain types of utilities. We also see it in healthcare companies that have gone well, and consumer staples businesses that are kind of growth slowdown proof, so to speak.
So it sounds like a value trade from growth.
Yeah, I mean, our positions across portfolios right now is, from a style box point of view, is very much in the value bucket right now. And because that's where we believe the best place to compound will be. That is separate of all these larger bits of overexcitement that are deriving a lot of returns in other sectors.
And this position narrative sounds to me a little bit like some of the managers we've had where they, gain a lot of return or focus on short selling a lot, where they can be right. It just takes quite a while for that narrative to play out. It's been often said, in short selling that, don't fight the market. And the market can, I think Buffett have referred to him a couple of times now, that what was the saying? The market can be irrational longer than you can remain solvent.
Yes.
How's GQG dealing with the fact that you've made these calls, you've made these positions, And to date, that's worked against you in the returns and the way they're showing up. How are you managing that?
Way that we like to think about it is that, earnings are like gravity, and that over time, that's where you get your best returns, and that's where rationality comes to it, and the probabilistic nature goes to it over time. And sure, there is cyclical swings where the market might run to certain areas, but over time, if you focus on the fundamentals and those forward-looking fundamentals, then you can compound capital the most effective way and that's how we've done it over time. So it's interesting. You look at let's say savings solvent. We've had a year where we haven't participated in this kind of larger market kind of growth, and the fund base of the business is basically flat. So it's not like we've lost money over this period. And the view is always not how do you make up for the year before. It's always how do you compound capital best from a forward basis. Mm-hmm. And what we've seen over the year is that all the things that we're not investing in, for the most part, they've continued to deteriorate more, even if the market's kind of run up more. So our view is that the longer this goes on, almost like the better positioned you are when eventually you see that shift in capital within markets. And I feel like you're already seeing it right now.
And does the firm have a view for what might be a catalyst for that?
Yeah, I mean, there's a few things, and they've been over. We've spoken about it a bit. The most obvious one, I think, on the surface, for things pulling back, mm-hmm. Is this element of tech over earning or tech overspending on the capex side. So, I mean, if there's a blunt endgame view you want to have, maybe you can look at one of the hyperscalers pulling back capex, and then all the hardware side of it unraveling. And also this recognition that some of this capex spending on data centers is probably a bit of a waste to a certain extent. They're not going to see that. And you'll see that redistribution of capital go across the market. And I'd argue, again, since November, you've seen that under the surface kind of already. Mm-hmm. You've seen the market kind of plod along flat, where you've seen other defensive areas kind of come up. So that catalyst potentially is already happening. The other potential catalyst is you see funding come out on the server data center side and the private credit side. So the split of where the spending is coming from is about 40% hyperscalers, 60% kind of small providers, a lot of it fueled by kind of private credit. If you see capital dry up in some of those funds, that could be a quick reversal too, because they don't have. We're not saying that these hyperscalers are going to get broke. They're finding ways to continue to do things over periods of time. But on this side, there's no other levers to pull, and that could deteriorate quite rapidly. So there's a number of things there that could happen. I mean, we could talk about this for a little longer, but I'll stop there.
David, thank you. You've been very generous with your time. Thank you for talking us through the thesis there in GQG and the white papers, which I'm sure people can find those online. If they want to go and read those. Thanks for joining us at Inside the Rope.
Pleasure. Thanks for having me.
Well, welcome back. I hope you enjoyed the episode. Plenty there, I think. Tom, what were your key takeouts?
Yeah, it was a really good episode. I think the key takeout was really that, he's not saying AI is fake. It's just that the maths may not stack up. And that's what leads a lot of their thesis around not allocating a lot of money to AI at the moment. I know in the past there was articles about OpenAI, for example, depreciating their GPUs over 5 to 6 years when their lifespan's really only 2 to 3. So there's some creative pieces around that they're not quite sure about. They talked a lot about how they're positioning portfolios. So in some of the under-owned earners, so insurance, utilities, healthcare, and staples, which is quite interesting in the current environment when a lot of the market is rotating into that tech space. And then some of the circularity risk. So coming back to the whole hyperscaler, data center, private credit into both of those asset classes, and then backing into AI, it can paint a pretty scary picture at the moment when we think about where capital is being allocated. So that was really fascinating.
There's plenty there, isn't there? For me, I'm reminded, I don't know who the saying was. It might have been Gates that we sort of, we underestimate or we overestimate how much is going to be changed in the next 2 years and underestimate in 10 years. And it just drives home to me that picking the winners can be really hard. I remember advising clients through the dot-com crash and that whole digitization piece. You could see that there were going to be some clear losers, but identifying, something like Instagram as the winner through photography after Kodak invented and tried to hide digital photography, it just wasn't obvious. And I feel, the market's probably overdone. We've seen a big pullback in the last few weeks on, anything software generated that AI is going to eat its lunch. I think there's going to be some nuance around that and how these things play out and what the real value add is going to be when I see that play out, and it's not going to be obvious. The other big thing I think is, just got to be careful. I think you faced into is how some of these things are interlinked, and you think about the bubble at the GFC where a certain sort of debt was taken, really bad, poor, low-rated income washed through a vehicle through an investment bank and comes out 5-star. You just got to watch that the labeling of investments at the moment, and your point around data centers particularly, and people think they're buying infrastructure assets where you might be buying the latest greatest right at the edge of technology data center, which might be obsolete in 3 or 4 or 5 years, who knows.
And that's interesting too. I mean, if we look at AI and how quickly this is evolving, right now there's a big pivot from training models to inference models, and that is moving from training the actual AI and using a lot of compute power to saying, hang on, this is really useful, but how can we make it more efficient? And then what are the implications on data centers, hyperscalers, and all the contracts underneath them going forward if that whole ecosystem changes? So
it just brings me back to diversification and patience.
Absolutely.
I think in the long term, there'll be a huge growth story in the AI area, but it's going to be bumpy. Look at all those tech companies that have been, down more than 50% over their last 10 years. They've been great investments over the last 10 years, but it's a wild ride. Thanks, Tom. Appreciate it. Hope you enjoyed the episode.
Thanks, everyone.
Thank you for listening to Inside the Rope with David Clark. Be sure to subscribe to this podcast on iTunes. You can connect with David by visiting codacapital.com. Any views expressed in this recording represent the personal opinions of the speaker and do not represent the view of any other party. If this recording contains reference to any financial products, that reference does not constitute advice or recommendation and may not be relied upon. Listeners in Australia are encouraged to visit www.moneysmart.gov.au to obtain information regarding financial advice and investments.